Hey, what's going on YouTube? In this video, we're going to go over Rover Group, ticker symbol ROVR. They reported their Q3 earnings November 6th, beat on top and bottom lines, and with their earnings, all 8 analysts had revised their next EPS revisions higher. Year to date, company is up about 112%. Over the course of 1 year, is up about 82%. And there is about a 3% short interest on the company, but honestly, once we get over the financials and everything and over their thank you, I don't know that I'd want to be one of those people shorting this company right now. So what this company does is they operate an online marketplace for pet care worldwide. So it connects pet parents with pet providers who offer overnight services, including boarding and in-home pet sitting, as well as daytime services such as doggy daycare, doggy walking, drop-in visits, grooming, and training. And in their earnings call transcript, it was very bullish. The whole thing, I mean, there wasn't anything to probably be very concerned about at all. So over here, we see new customer bookings of 290,000, up 8% over last year's record levels. Gross bookings in Europe grew 71% and 35% in Canada, which represents about 10% of their total non-US market revenue. And this is the crazy one, is gross booking for cat only bookings in Europe was up 134% and 58% in Canada. So we're seeing obviously some pretty significant growth at the company. Also down here, we're going to jump down a little bit here, that they saw approximately 13% of their revenue increase was driven by higher average booking values of $142. So one thing is for sure is people are always willing to pay money for their pets. I mean, they will almost buy whatever and pay whatever it costs for their pets. So obviously the company increased their average booking value is now at 142, and then we come up to here and we can see their average take rate was 22.4%, and with this increase now their take rate is sitting at about 23.6%. So obviously one thing we know is people are willing to pay for their pets, right? Whatever that case may be, whether it's training, boarding, or somebody watching their dog while they're on vacation or gone for the day or at work, whatever the case is. So obviously they increased their average booking value is now $142 per service, you're right, per unit service. And with that increase, it didn't slow the company down. They continue to see growth. So that kind of tells you maybe they got some pricing power, right? Potentially. And then so they could potentially grow their average booking value a little bit more over the course of time, which obviously then would increase their take rate. So obviously their revenues will grow, their take rate could grow. And then obviously then on top of it, I mean, it's just basically an all cash business. There's not really much overhead to it. So pretty interesting. I'm a big fan of this business model. And then also what this company is doing is buying back more shares. They repurchased 9.1 million shares. They obviously add some stock-based compensation and everything else. So they bought back 9.1, but they also handed out more. Well, not more than what they bought back, but they handed out some of what they bought back. So then that leaves with about 180 million shares outstanding. Also, the board approved an additional $100 million share buyback program. So over to the financial spreadsheet, we come over here to our charts. We can see our revenue, gross profit, net income, all trending in sync with one another, which is fantastic. Net income just turned positive, and this company is forecasting for some pretty significant growth in the future. Gross margin sitting at 79.4% for the last quarter, trailing 12 months, basically 78%. Net margins trailing 12 months, 5.1. Last quarter, 15.9% net margins. So very significant increase on net margins. Trailing 12 months, revenue and gross profit growth rate sitting about 25 and 27% growth. PE ratio, since this company just turned a profit, our PE ratio is always going to be a bit outrageous. Earnings yield sitting negative, and our return on invested capital negative 7%. Net income to free cash flow, company is just now starting to turn positive net income, and then that carries over to free cash flows. So now we're starting to see some positive free cash flows as well, which is better yet. Free cash flow sitting at $8 million. Capital expenditures maintaining around $8 to $9 million right now. Share count dilution, as we can see, there is an increase obviously in share count overall, but last quarter to trailing 12 months, we are in line with where we have been. So we're not getting diluted as shareholders were so far with their buyback. They are still handing out shares and they are still issuing out more shares, but they're buying back more than what's getting handed out. So what this stock-based compensation is doing is making their free cash flows look better than what they really are. But Once we go to the 10Q, we'll kind of go over that real quick as well. So onto their balance sheet. Company's got about $205 million in cash. We come down here to our liabilities, and we can see we've got deferred revs and pet parent deposits. I'm going to assume those pet parent deposits are also going to be considered future revenues. So I'm going to also include those as if they're deferred revs. So I deduct out those two numbers. That gives us a $63 million subtraction from their $107 million of their total liabilities, which leaves them with $44 million in debt. Minus off their cash, still leaves them with a positive net cash of $161 million. So fantastic balance sheet. On top of it, if you want to leave those deferred revenues in there, you still can minus off $107 million from 205. Still net positive cash on the overall balance sheet, and this company appears to not have any debt at all, which is fantastic. And also, one thing to keep in note is they got $75 million in short-term investments. And once we go over here to the income statement, look at that interest income. They're earning interest on their cash that they've got just laying around. So that's even better yet. So I really like a lot of things that this company is doing right now on their overall financials. So revenue then comes in the last 3 months at $66 million. After you pay everybody, everything gets paid for. One thing I noticed too is their general administrative went from $30.6 million down to $13.6 million. I'm not real sure what that significant increase, or in this case decrease, was. Usually when you see a big increase in G&A, it might be some sort of legality thing that could have occurred within the company. Usually you put lawyer fees and stuff like that in general administrative or something like that. So maybe could be something worth looking into. Just because the big deep reduction in general administrative is probably a one-time occurrence there, and potentially that should probably not arise again unless they have another potential lawsuit or something like that. But that leaves them with an income from operations of 8.4 million. Also worth noting, if they did not have that increase, they probably would have been super close to, actually, you know what? They would have been very close to net positive this time last year too, if it wasn't for that big increase in G&A there. But overall, net income came in positive at $8.4 million. And then we add on our interest income, gives us about $10.5 million in net income last quarter. Over to the cash flows. We got over the last 9 months have done $5.6 million in net income. Add in stock-based compensation, also some depreciation, along with impairment loss and intangible assets, goodwill. And then you come down here and you've got net cash provided by operating activities of $9 million. You got capital expenditures of $550 million. And then so that leaves you with $8.5 million in free cash flow. So very good. So overall, the financials on the company, in my opinion, they look pretty decent. Over to the Peter Lynch valuation on Rover. Gives them a fair value of $4.91. Manual PE, we take our market cap minus cash. Add in debt divided by cash from operations. Take about 87 years for this company to earn its current market cap. But we can deduct out some of that debt as well. Obviously, we've already kind of gone over that. So if you wanted to, you could do that. Price to book, same thing. You could deduct out debt, but obviously the 5-year average is not based on that. So it's going to be 2.94. Currently 5.36, so a bit high in the price to book. PEG ratio is very, very richly valued, but obviously this company just turned up positive net income and positive earnings per share. So that is going to be very elevated right now. Graham's valuation gives them $8.11 per share. Discounted cash flow. Average growth rate has been negative 124%. Analysts have a growth rate of 40%. I gave them 25% growth rate in free cash flow. That gives them $1.86 per share. Rule 72 with 3 EPS growth rates. I had to skew these numbers a little bit. As you can see, our double would normally be 6, which would give us a future EPS of 4, which if I even plug in 4, I don't think that's going to be a very valid number. So I gave them 0.7 for a future EPS, which still gives them a fair value of $14.22. Over to the summary. Currently trading at $8.57. Our fair market value today is $7.27. 30% margin safety, $5. Analysts have a price target of $7.71. So we're coming pretty close to it, within line of where analysts are. One thing I want to do though, and we're probably going to start doing on every analysis going forward, is typing in the forward looking EPS and forward looking PE ratio as well, that we can come over here to Seeking Alpha and get those numbers. So we can see our forward EPS is 10 cents and our forward PE is 87.5. So what we can do is come over here, type in our 10 cents, and then type in our 87.5 for our future PE. And then that gives us a fair value today of $8.19 on Peterlynch valuation. That cuts our PEG ratio down almost in half. Also, Graham's valuation then gives us $13.51. Our DCF will not change. Typically, our Rule of 72 would change, but because of the already elevated earnings per share estimates, we're just going to maintain our 70-cent EPS forward looking. New fair market value then forward looking would then be $9.44. 30% margin safety, $6.61. So you could say we might be slightly undervalued. So over to the stock chart on Rover. We can see we are just on a tear to the upside. We are nearing maybe a resistance point. We see a couple tails right here. And that's kind of where we're trading right now is about $8 and call it 60 cents roughly, give or take a little bit. So we could consider that maybe a little bit of a resistance point but with how much momentum is built in with this stock right now, it's just ripping higher. I bet we're gonna probably get up to about $9 to $10 per share. Probably I would call it $9.50 to $10 per share before we see a potential pullback. We might see a little pullback here and there by the time we get up there. But we can see there's a lot of resistance right here at about $9.50 per share. You know, maybe you sneak up to about $10 per share with the excess momentum in it. And then I would have to assume we'll push up to here, which is about our forward 12 months valuation is about 944. So that makes sense. That's within line of our expectations, our valuation. So it runs up to here, and then we might see this thing trickle lower and then maybe come back down and retest this purple trend line. And then by that time, earnings might come out for the next quarter, and then we might see this thing resume back higher. Maybe we'll bust through $9.50 per share and start to make some different resistance and support ranges. But if we do that, our next resistance point is probably going to be about $11.50 per share. So, but that is it for Rover. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another stock analysis video.